Right, guys. What did you say?
Oh, we're not doing QuickBooks? We're not doing Coffee Cafe? Sales?
No, I need to show you this last thing so you can take your quiz.
Yeah, we got the quiz Sunday.
Yeah.
But
All right.
I'm a guy, so we're behind, I think.
Okay. Well,
I'll get it.
anyways, so here we are finally reaching up to the conclusion of our class, right? We've gone through the very beginning stages of learning how to do a transaction, and now we have finally reached the part where we actually start to close our transaction. So, again, let's go over our accounting cycle again. So far we have seen the first four steps of the accounting cycle, right? We started off with collecting our source documents, right? So all those receipts, all those invoices, all those things that we need to send out. We understood how to take that information and we did step two, which is to analyze it. How does this transaction affect my books? Third thing that we needed to do is we need to post that transaction in our general journal. All right. Lastly, the last thing that we learned was step four, which is to post it directly into your general ledger, which we have done so far. Now that we're moving into the closing process, now we're going to be looking at the last five steps. Actually, we actually touched upon the pre preparing the unadjusted trial balance, right? We did a couple trial balances here and there, right? But this one's more geared towards the end of the month, right before we actually start the closing process itself. Okay, so step five is going to do a trial balance. So this is at the end of the month, which we will get to see. The step number six is going to be adding our adjustment entries, which I'll talk about in a minute. Then step number seven is going to be preparing the adjusted trial balance. Then we're going to move into our financial statements. Then we're going to close our books. And then lastly, we're going to do a post-closing trial balance. Okay, so let's go ahead and review step five again. So what is this unadjusted trial balance? This is going to be everything before you do your adjustment entries. Okay, pretty straightforward, right? We've done simulations of doing this, right? We just want to ensure the accuracy of our accounting by making sure that by the end of the month that all of our transactions have gone through it and everything pans out even. Okay, so we want to make sure that our debits match our credits, which is the ultimate goal of all of accounting, right? We want to make sure that we reach that conclusion. Okay, then we're going to move into step six. Step six is going to be introducing to adjustment entries. And what these are is, okay, so yes, we have seen bits and pieces here left and right when we were talking about concepts in throughout the accounting, throughout the chapters, right? We looked at what an adjustment entry does. Okay, so just to give you a little refresher here, periodic inventory, when we do the conversion, that is considered an adjustment entry. It's something that we do at the end of the period. So that is typically what the adjustment entries normally do. They usually are done at the end of the period, all right? Depending on how often you close your books, right? Depending on when you schedule to have the accounting cycle done is going to be what your accounting period is. Okay, so that's a perfect example of one. Okay, depreciation, right? Remember when we were dealing with our assets, right? When we purchase them, we have to expense them somehow, right? Right, because the parts are being the assets that they're being used. They're not worth what you bought them originally. Other things are like supplies expense. So again, when you buy supplies, the purpose of buying supplies is you're supposed to use them, right? In accounting, we change the word use to and we convert it to an expense. Okay, that's our language right there. To expense something is to use something. Okay, So we're going to be looking at adjusting our supplies, like how much do we have supplies left. And then lastly, cost of materials, which is the same thing as using your supplies. And then bad debt expense is going to be one of them. So remember when we had the allowance counts, right? If we know that this person is not going to pay us back at that a given point, we need to adjust our accounts receivable to line up with those bad debt that we're not going to ever receive. So those are pretty much the key 5 that we will look for in this class. Now, going into the real world, you're going to have way more adjustments than that. You're going to probably have 20 other adjustments that you've never heard of before. But again, this is just beginning. I'm only going to get your foot wet, okay? I'm only giving you typical things that you would normally see and that are often usually calculated. But again, when you're into the real world, it's a completely different environment, okay? You're going to be looking at way more adjustments, okay? So, yes. So once we've done that, then we're going to create an adjusted trial balance, right? So what the adjustment trial balance is it's going to be your trial balance, except you're also going to include all of those adjusting accounts, such as entering bad debt expense, right? Entering supplies expense. Those are going to be incorporated into your trial balance, and it has to just the same thing has to happen. Your debits must match your credits at the end of the day, okay? Just to make sure that when you did your adjustment, that you did it correctly and that you didn't overstate one side than the other, okay? That you correctly transferred from one account to another, okay? And then when we move on to step 8, it's going to be introducing you to the financial statements. So if you guys vaguely remember about 18 weeks, about maybe 18 is too much, about this class is only 15 weeks, about 10 weeks ago, I would say, maybe 12 weeks ago, I kind of gave you guys a little bit of exposure of to what a financial statement looks like. If you were in there are 4 financial statements available, right? We have the profit and loss, or also known as the income statement, right? This is the number 1 statement that you must always do first. Why? Because it pretty much gives you a summary of the entire reason why you're doing business. The main real reason why you're doing business, especially in sales, is you want to see if you made money. You want to see if you even made a profit or a loss. Okay? And this is a very, very important factor that you do know, because when you're going into business and you're starting out as a business, you need to know that one rule. If your company does not make profit 3 out of the 5 years, that business becomes a hobby. So this is very important that you know how to calculate your income statement. So again, what it entails is basically it's all of your revenues, every single one of them, all of your revenues, and you're going to subtract all of your expenses. And that's it. That's it. So, because Coffee Cafe is going to be in the business of selling coffee, we're going to have to go through every single thing that we sell. So we're going to go through selling our regular coffee, Supreme coffee, our coffee mugs, right? We're going to look at all of that. And we're going to include everything that is part of revenues, okay? And then we're going to subtract, obviously, our cost of goods sold, because cost of our goods sold is part of our expenses. It's the purpose of us keeping track of our inventory, but it's also keeping track of the things that we sold, the things that we don't have anymore, right? So we got to calculate that. And when you do that, that's where you're going to get what's called a gross profit, okay? That's just a rough estimate. It's going to be just saying, before you take out any other extra deductions, this is your gross right now. Once you've solved for that, then you're going to subtract any and all of your operating expenses. Okay. And then once you've gone to that, you will there are some things that are in here that you will see that aren't something that we calculate for this sake of this class, but you will be introducing to anything like any non-operating expenses or any non-operating income or other income they call it. So if you have any of those, you're gonna have to calculate those as well. And then lastly is going to be income tax. Now, depending what kind of business you are, if you're a corporation, you have to take out your income tax. You have to take your income tax out. But if you're a sole proprietor or like a lot smaller, you can actually get away with this. You may or may not have income tax. It just depends on what the scenario, and if you reached a certain amount of dollars, that's when you actually calculate the income tax. But it is part of it. But other than that, if we were to just remove all of that, just by doing all of your sales, all your revenues, subtracting all of your expenses, should give you, if it's a positive number, you made a profit. If it's a negative number, you made a loss. Okay? So that is the income statement there. Lex,
Just to ask that
Yes.
basic question, I know you're probably already doing it, but since I didn't see it, you're recording this, correct?
yes.
Okay, good.
Okay. All right.
Checking, that's all.
Nope, that's okay. You check every day with me. That's okay. Okay, so then so we're still on step 8. We're doing the second part of our statements, okay? So when we do when we're dealing with our income statement, right? We also have to adjust our owner's equity, right? We got to reevaluate our company. What does it stand for? Not what it stands for. How much is it worth now? What is the value of it as of today? Now, of course, you have two options when it comes to owner's equity. You can either take your profit and pocket it right into your pocket, or you can reinvest it into your company. Okay, so in this step right here, because we're a small company, we're trying to start off. General rule of thumb: you don't want to take that profit out. You want to reinvest into your company, just because you want to have your company to have sustainability. Second of all is, what if one day, because of all those expenses that you bought, just try to get your business up, just by you taking all that profit and putting it in your pocket and just spending it on however you please, that money will bite you in the end of the day when those bank loans and all those people that you owe come after you. So you want to also be very smart about reinvesting your money into the company. So this is what we're going to be looking at. So we're going to have we're going to start with our beginning balance of our equity, okay? And then we're going to add if we have a profit, subtract if we have a loss, okay? All right. So because profits would increase our worth, right? Because you earned the money for it. If you're at a loss, that means you have to pay into it. You have to pay out. So that's why the first rule of thumb is going to get either add or subtract your net income / loss. Okay. Anything that also contributes to equity would be anything like capital contributions. So again, capital contributions is when you put your own money into your company. Okay, so let's say you just got your taxes back, right? You're like, oh, I have $5,000. Why not dump it into my company? That's what a capital contribution is. It's a contribution to your own company. Anything that decreases equity would be if you were to take money out, which is the owner's withdrawal. Okay, so this is where you're going to calculate. You add or you subtract. And in this case, you're going to subtract any owner's withdrawal that you have taken out of your company. And then from there, you're going to calculate your total to get a new total value to reflect your equity plus your profit minus any withholding. I mean withdrawals. Okay. So basically, we're just evaluating your company at the end of the period. Okay. Now, once you have this new equity right here, okay, it's important that you keep in mind what that number is because it will show up in the next statement. Okay. So the next statement is your balance sheet. Okay. This is where you are going to test out the accounting equation, which is going to be your assets equal your liabilities plus your equity. Since we've already calculated equity from the previous statement, we're going to take that equity and we're going to bring it back over here into the balance sheet. So we have equity already. Now, all we need to make sure is, does our assets equal the total liabilities and equity? So this is where you're going to whip out all your accounts again, and according to what account they belong to, you're going to make a list of all your assets, and you're going to add them against your liabilities. Okay, and then you already calculated your equity. Okay, so that's all that is. It's just testing whether the accounting is correct. All right. Last step that we're going to be going into is going to be the statement of cash flows. Now, the statement of cash flows it can be very tricky to calculate. Reason being is because there are many factors, many accounts that could be taken into consideration, and for some reason it doesn't. Some work, some don't. Okay, now I have been struggling for this with Mr. Sanchez for almost a year now, and we're still short by some odd number. We're still short by some odd number, but I do want to get you the general, just the general understanding of what the cash flow does. Now, cash flow pretty much takes the idea of understanding how much cash is really flowing into the company and how much cash is actually flowing out of the company. So we're going to be looking into 3 categories, which is going to be your operating activities, your financing activities, and your investing activities. Okay, so again, these are kind of geared towards your current assets, your long-term assets, your current liabilities, and your long-term liabilities. Okay, because most of those accounts, right? Are they really cash? All right. No, they're not. An asset is definitely not cash, right? You have to sell it in order for it to be cash. Now, understanding that, just that concept right there, what cash basis does is it basically liquidates every single account that is not a cash, that's already not in a cash basis. So basically, everything that you learned up for cash basis, everything that you learned up for accrual basis is going to be thrown out the window because now you're going to convert it back into cash basis. Okay, so this is why for operating activities, we'll be looking to actually doing this. You're going to convert your accounts receivable and convert it into cash. Okay, straightforward. That's it. Okay, so again, we're going to be comparing our beginning cash flows to our ending cash flows. That's going to be where we actually define whether we did it right or wrong. Okay, so again, we're still in the works of trying to find that extra error. So yes. Okay, so that's the statement of cash flows. All right, then lastly, actually closing out all of the books. Okay, so what does this even mean? We are going to close out all temporary accounts and we're going to close them all out into the income summary. Again, we're going to close out all temporary accounts to our income summary. Can you tell me what a temporary account is? What are your temporary accounts?
Any account that's easily made into cash?
No, no. With that's the previous one. No. Okay. Let's take a step back then. What are the 5 accounts that you know? What are the 5 types of accounts?
Assets,
Uh-huh.
liability,
Uh-huh.
equity,
Uh-huh.
revenue,
Uh-huh.
Expense.
Expense. Good. Now, out of
Expenses, we have
Okay.
revenues.
mhm. Mhm. Now, out of those 5 types of accounts, 2 of them are temporary. They close out at the end of the period.
Lynn, I'm sorry,
Yes?
you're cutting in and out. I can't gather your sentences.
Oh, okay. Oh, don't worry about this. I'll post this on there so in case like you do need to go back and review it, it's there. Okay.
Uh-oh.
Sorry. I'm sorry. I don't know what to do. Yeah. All right. So again, there are 2 types of accounts that close out at the end of the period.
expenses and liabilities,
Expenses is one of them, but liabilities is definitely not one of them.
revenue.
Yes, expenses and revenues. Why? Because at the end of the day, your permanent accounts, the reason why they don't close out is because they're constantly being revised all the time, right? You are constantly purchasing your your inventory. You're constantly going to you're going to constantly owe your people, right? You can't just close that out. That's not cool, right? You can't just owe people and not pay them back. So those are the reasons why those are considered open accounts. Closed accounts, such as your revenues and your expenses, those will never occur the same. I don't know if that makes sense. Sorry. Let me reword that. So every month or every period that you have, you're going to have a different type of income. You're going to have a different type of expense. And I just realized I had the answer on the screen the whole entire time. So yes, your revenues, okay. So your revenues, right? You're never going to have the same sales as you did yesterday.
No.
Okay? You're never going to incur the same expenses as you did yesterday. The only thing that's actually constant would be like, rent expense, right? You have to pay that every month and it's the same. But again, there's always a possibility that your rent can go up.
Yeah.
So that's the whole key factor of understanding that concept is that you're never going to have the same exact revenue or expense to occur in the same given period. Okay, so this is why, because that is an inconsistent factor, that is why we want to close our accounts, and that's also how we measure our profitability, right? This is how we can measure, oh, this month I did well, this month I didn't do well, but the third month I did extremely well, right? Because you have you have a point of measurement by closing out your accounts. You measure from 0 to start. I mean, you measure from start to finish. Okay, so every time you close out your period, that way you can measure especially for sales, right? Your profitability, right? This month I made a lot of money. Last month I didn't do so well because I bought too much stuff. Okay, so things like that. Okay, so this is why our revenues and our income, they're the same thing. Revenues and income and our expenses close out to the income summary. And how do you zero out accounts? How do you make an account balance 0?
Debit account.
Depending on what flow it is in. So right now, because we have revenues are considered credits, then yes, you would debit them for the same exact amount just so you zero out the account. For expenses, they normally have a debit balance. So in order to zero it out, you would zero it out with the same amount of credits to clear it out. Yes, good. All right. Once we do that, that's where we actually start closing our books. So for this example, we're gonna close out all of our sales into our we're gonna close them out to the income summary. So for this example, I debited all my sales and I credited them into the income summary. And then what I'm going to do here is I'm going to debit my income summary and credit all of my expenses that occurred that given period. And once you've done that, you're going to create a balance in your income summary. Oh, that's what I forgot to do. I forgot to include the translations from the income summary to the equity. Oh, it's at the bottom. Okay, so once you've created an account balance, right, in your income summary, right? So here you have a credit balance in the beginning, and then you have a debit balance, and now your conclusion is that you have a credit balance in your income summary. Therefore, you're going to zero out your income summary into your equity. And one point of reference to make sure that you did it correctly is your equity. And when you do your adjustment, your equity should equal the exact equity that you calculated in your statement of equity. Okay. All right. So there you go. That's how you close out the books. And then lastly, you're just going to redo your trial balance again, but this time you're going to have all of your assets and all your liabilities, and you're going to have a brand spanking new equity account. Okay? And that's how you close out the entire books. So again, chapter review, you need to know the steps. It is important that you know because we are going to complete the whole entire accounting cycle. All right. Understanding when we are doing a trial balance that the goal of a trial balance is to have your debits match your credits. Okay. Understanding that when we close out all of our revenues to inventory, we're going to close out all of our expenses into did I say inventory? My bad. We're going to close out all of our revenues into the income summary. And then we're going to close out all our expenses into the income summary. And the last step is to close out our income summary into our equity. All right. And then here are the last four financial statements and adjustment entries, like what typical things that you would see. Okay. All right. So, any questions in regards to the adjustment? Just closing our books in general.